The Canada Pension Plan benefit is one of the most valuable retirement assets for most Canadians, but its value can change materially depending on when the benefit is claimed. This makes planning to get the most out of it a valuable exercise. Fortunately, research at the intersection of financial planning and actuarial science provides a lot of insight into optimizing the CPP timing decision. I'm Ben Felix, Portfolio Manager at PWL Capital, and I'm going to tell you how to get the most out of your CPP benefits. For most retirees in Canada, deciding when to claim CPP benefits is one of the most consequential financial decisions that they will make. The difference between a good choice and a bad choice can measure in the hundreds of thousands of expected lifetime dollars. Let's start with some fundamentals. The CPP benefit is calculated as a percentage of the maximum pensionable earnings, or MPEA. The MPEA is the average of the trailing 5 years of YMPE, or yearly maximum pensionable earnings. If you're already sick of acronyms, buckle up. More recently, the YAMPE was also introduced. Historically, the maximum CPP benefit, what we would today call base CPP, was simply 25% of the MPEA. However, recent CPP enhancements are gradually introducing a second earnings ceiling and increasing the replacement rate from 25% to 33.33%. The way this breaks down is that the first additional CPP maximum benefit, once it's fully implemented, is 8.33% of the MPEA, so 25% plus 8.33% brings us to 33.33% of the MPEA. And then the second additional CPP maximum benefit, once it's fully implemented, is 33.33% of the MPEA adjusted difference between the YAMPE and the YMPE. If that made your head spin, don't worry about it too much. These additional benefits will only have a small impact for people retiring in 2024 and will be fully implemented by 2064. The important point to understand here is that the CPP benefit is based on the MPEA. The maximum pensionable earnings numbers that I mentioned are increased each year based on Canadian wage growth, which has historically outpaced inflation by about 1% each year. Once the CPP benefit starts, it is indexed to the CPI All Items Index. The important point here is that the CPP benefit is initially calculated based on the MPEA, which is indexed to wage growth, while once the benefit has been claimed, it is indexed to consumer price inflation. With that background out of the way, to understand how the CPP timing decision can be optimized, it's important to understand how timing affects the benefit. There are two main channels. One of them is relatively well understood, but the other is not. The easy one is the statutory increase or decrease in the CPP benefit for claiming it earlier or later than age 65. The CPP benefit can be claimed anytime between the ages of 60 and 70. There's a 0.6% reduction for the total benefit each month prior to age 65 for a maximum reduction of 36% at age 60, and a 0.7% increase for each month after age 65 for a maximum increase of 42% at age 70. This means that if we take age 65 as the baseline and you're entitled to the maximum base CPP at 25% of the MPEA, you could increase that figure to as much as 35.5% of the MPEA by delaying to age 70. And you could decrease it to as little as 16% of the MPEA by claiming at age 60. That aspect of deferring CPP is relatively well understood. People generally get that there's a penalty for taking it early and a bonus for deferring it. But the other factor affecting the lifetime benefit is wage growth. Remember, deferring gets you a larger percentage of the MPEA. Let's take a 65-year-old as an example. If they take CPP today, assuming that they have sufficient contributions for maximum base CPP at 25% of the MPEA in 2024, they would get about $16,000 in CPP benefits. If they defer to age 70, two things will happen. They will get a statutory increase of 42%, and the MPEA will increase with wage growth. Assuming 1% real wage growth, the increase in the lifetime benefit relative to an age 65 baseline is 49.2%. Instead of a $16,000 benefit, it would be about a $24,000 benefit. That $24,000 is adjusted for inflation to be directly comparable to getting $16,000 today. Getting this increase does, however, require waiting for 5 years, which means drawing down other assets. Instead of waiting, it's common for financial advisors to tell their clients to take CPP at age 60 so they can avoid touching their investments. A 2020 paper from the Canadian Institute of Actuaries and the Society of Actuaries suggests that for Canadians with sufficient bridging funds from RRSP or RIF retirement savings, the choice to delay or not delay CPP payments comes down to expectations about longevity and financial market returns. The paper finds that if a risk-free investment with a rate of return of 1% above inflation is available, anyone who expects to live past age 80 should defer CPP to age 70 rather than take it at 65. The authors note that only a fifth of female CPP recipients and a quarter of males die before age 80 under current CPP actuarial tables. In the case of a risky investment, the paper finds that assuming a 4% rate of return with a 4% standard deviation, roughly in line with PWL Capital's expectations for a fixed income portfolio, a 65-year-old male with high expected longevity would face a 73% probability of receiving less lifetime net income by claiming CPP at age 65 instead of age 70. For women, who tend to live longer, the paper finds an 81% chance of being worse off from having taken CPP at 65 instead of 70. They also look at a 6% expected return in line with PWL Capital's expected return for a 70% stock and 30% bond portfolio, and find a 57% chance of being worse off for men and 65% for women. Higher expected returns and lower expected longevity would make taking CPP earlier look better, all else equal. But even in the high expected return, low longevity case, the paper suggests a 51% chance that a male ends up worse off and a 60% chance that a female ends up worse off from having taken CPP at age 65 rather than age 70. The paper concludes that the majority of Canadians with sufficient savings in their RRSP or RRIF have a high probability of making themselves better off in the long run by deferring the CPP benefit to age 70. Despite the clear and measurable benefits of delaying the CPP benefit, as of 2023, only a little more than 5% of Canadians defer to age 70. The majority claim the benefit at age 60 or age 65. There are a few possible explanations for this behavior. A simple explanation is that people don't know any better. A 2018 survey conducted on the Government of Canada website found that only 36% of Canadians aged 40 to 64 were aware that they could defer their CPP benefit to receive an increase. Another possibility is that CPP advice is misguided. One of the most common approaches to examining the CPP timing decision is through break-even analysis. For example, if you take CPP at age 65 instead of age 60, you'll need to live long enough to collect the higher benefits to make that deferral worthwhile. Break-even analysis is affected by the fact that people tend to underestimate their own longevity and the fact that the break-even framing makes deferring the benefits seem like the risky option. Empirically, Americans presented with break-even analysis are more likely to claim Social Security as early as possible. While it's casually appealing, break-even analysis ignores or underemphasizes the benefits of CPP. Remember, the CPP benefit is a guaranteed inflation-indexed annuity. It protects against adverse scenarios like bad market returns, high inflation, and a longer than expected lifespan. An alternative approach to break-even analysis introduced in a 2020 paper is the lifetime loss, which takes the present value at life expectancy of the expected loss from having taken CPP at an earlier age rather than a later one. This approach flips the framing to early claiming being a loss and more appropriately captures the lifetime value of CPP. Another possible explanation for early CPP claiming is our old friend conflicts of interest. A 2023 paper in the Retirement Management Journal finds using US data on Social Security claiming behavior that households with financial advisors who are paid on commission tend to take Social Security earlier than those with hourly or fee-based advisors. Their results suggest that, to nobody's surprise, financial advisor compensation methods can have a significant impact on the scope and quality of financial advice. While this video has so far focused on the arguments to defer the CPP benefit, there are cases where it does not make sense to do so. An obvious example is people who do not have any funds to bridge the gap between ages 60 and 70. Another important consideration is life expectancy. Those with lower life expectancies would generally want to claim earlier than later, but importantly, many people underestimate their own life expectancy. This decision should be made carefully and not based on a casual assessment of life expectancy. Another example is lower income Canadians eligible for the Guaranteed Income Supplement. They have to be very careful about increasing their taxable income past age 65 as the effective tax rate, that is the tax rate including clawed-back government benefits, can be well over 50%. In these cases, taking CPP at age 60 is often the right move, though all cases should be considered based on their specific facts. Similar comments can be made about old age security clawback. To the extent that deferring CPP will result in OAS clawback, careful consideration should be made about whether deferring actually makes sense. Another interesting case occurred in 2022 that would have favored taking CPP before age 70. Remember that the CPP benefit is based on the MPEA at the time that you claim, which changes based on wage growth, and is then indexed to CPI once the benefit has started. The benefit of deferring consists of two parts, the statutory increase and wage growth, which typically increases faster than inflation. But in 2022, we had high inflation measured by CPI and low wage growth. The result was that someone aged 69 would have been better off claiming in 2022, getting a year of CPP benefits plus a big jump from CPI indexing the following year, than waiting until age 70 in 2023. This example goes to show that rules of thumb are always a challenge in financial planning. The CPP uptake decision is one of the most consequential financial decisions that most Canadian retirees will make. The difference between optimal and suboptimal claiming can measure in the hundreds of thousands of expected lifetime dollars. In general, deferring to age 70 is the wisest move, but there are many exceptions, including ones that I did not mention in this video. At PWL Capital, we model the CPP decision in comprehensive financial planning software that accounts for taxes, government benefits, and variable investment returns. In this modeling, we routinely see the benefits of delaying the CPP benefit in terms of a higher expected estate value and a higher probability of meeting retirement income goals. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you want to learn more about how PWL incorporates the CPP claiming decision into our financial planning process, you can book a meeting with us below. Before you go, I want to give a shout out to Jason Yee from Fine Point Solutions for providing feedback on this video. Jason has great animated videos explaining CPP on his channel.